Okay, let's get started. Good morning and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I am going to be walking you through how I am viewing the current market. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, we will be kicking off with the major equity indices, highlighting some key levels. We did see, quite a lot of, I would say, ambiguity in markets over the last couple of weeks. Obviously started by the banking turmoil, but also we have the Fed intervening and a very dovish Fed intervening, which makes it seem that we will be getting a rate cut very soon. I mean, a month ago, we weren't even thinking about rate cuts until, at the very least, November. But now, with everything that's been going on and with the uncertainty that's been creeping up, we will most likely be getting a rate cut as soon as June or July. But from there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model, highlighting which sectors are outperforming and which sectors are underperforming the overall market. We'll take a look at some subsectors of interest that I have for you today, and we'll end today's session with some bullish and bearish market observations. So starting off here with the S&P 500, and right now price is in a bit of, I would say, no man's land. On the weekly time frame, you can see the Fibonacci levels. We had a 23.6 fib level at 420 acting as major resistance. During the January rally, we did see strong momentum to that 420 level, but price was unable to break above it. And then more recently, the banking turmoil did see price decline down to the 380 level, which was our downside target for the last few weeks. And that was a 38.2 fib level. So that's how I identified that to be the potential downside target, and that acted as support. So right now, given the macro uncertainty, and given the neutral to maybe slightly bearish macro outlook, I would say equities are fairly neutral. And for the S&P, I would say neutral between 380 and 420. Yes, on one hand, banking turmoil is naturally going to see price decline, but on the other hand, a more accommodating Fed will naturally see price increase. So a bit of equilibrium here. And right now, price bang on in the middle between the 23.6 fib level and the 38.2 fib level, and I expect it to stay that way for a while. The one thing I will say is, with the banking turmoil, it does. The thought is that it may lead to a decline in inflation. It will reduce demand and therefore reduce prices. And in a way, if the banking turmoil does combat inflation, it does give the Fed the green light to be a lot more flexible with their monetary policy, and that is why they are opting in for most likely what's going to be a rate cut in the next couple of months. So we'll have to see what happens with the economic data, and also inflation data is does have a bit of a lagging component to it. So it'll take a couple of months really to see just how much of an impact the banking turmoil has had with respect to inflation. Moving on to the NASDAQ 100, looking at the QQQ ETF, and price has outperformed the S&P. This is simply due to the fact that, one, the NASDAQ 100 does not have the big financial names and the big banks that have been underperforming lately. And also, it has a high exposure to technology, which has been outperforming lately. Technology does very well in an environment where interest rates are declining, but does quite poorly in an environment where interest rates are rising. And right now, markets are pricing in the fact that interest rates will be declining soon, and there has been a lot of rotation. Despite this uncertainty, there has been a lot of rotation back into technology stocks, and that has seen the NASDAQ 100 outperform the S&P 500 by quite some margin in the last few weeks. But right now, price is just under this, I'll say 315 area. The 315 area did act as resistance in the past, and right now we are seeing it act as resistance in the last few sessions Wednesday and Thursday saw price actually reject that level on an intraday basis. But right now, we're not seeing a lot of that bearish price action that would normally be evidence for a downtrend. Instead, it looks like there's a bit of consolidation just before a resistance level and just below a resistance level. And normally that would lead to a potential breakout opportunity here for the NASDAQ 100. But a lot more optimistic here for the NASDAQ compared to the S&P 500. Moving on to small caps, looking at the IWM Russell 2000 ETF, and we had quite a bit of underperformance since the banking turmoil. I said it before and I'll say it again. This is an index, or an ETF, I should say, that has been respecting its key fib levels. And just a few weeks ago, we were talking about how impressive that the fact that price was staying above the 188 area, which is a 38.2 fib, staying above 188, and did look like it was after this initial bullish run, it did look like it was retracing nicely for a potential another bullish leg back to 210, which is a 23.6 fib level. But obviously with the banking turmoil, we saw a breakdown below 188 and a lot of bearish momentum. I mean, momentum was touching that oversold condition quite a few times. And we saw price immediately decline to the next fib level, which is a 50% fib level at 170. And so far, price is respecting that and actually managing to stay above it despite the underperformance here of the small caps. So risk to reward does naturally point to the upside for the Russell 2000, but there is a lack of momentum. And therefore, I would say price will still be under pressure for quite some time. Okay, taking a look here at TLT, which is a Treasury Bond ETF, and we have some very interesting price action, definitely quite ambiguous. Now, for the last few months, for those of you that have followed me, I was a big fan of shorting TLT at 108. Reason being was it was a previous swing low before the bottom at 92. 108 was a previous swing level acting as support. And once we had a better sense of what the Fed was doing with regards to inflation, and where at that time their target was around just over 5%, we saw a recovery in TLT back to 108, and that acting as a very, very strong resistance area. You can see that on the daily time frame, multiple rejections from that area, and provided a beautiful trading range that we could use for a few months. That being said, even though quite recently, actually, we've seen another rejection of 108, I'm not really seeing a lot of bearish price action. We're seeing a bit of consolidation. Yesterday was quite a bearish day for TLT, but still the risk to reward does favor the downside, but I'm less convinced of this being as easy of a bearish play as it was a few months back. A big reason, of course, would be due to the rate cuts or the pricing in of rate cuts. That could easily act as a fundamental catalyst for a potential upside break. So right now, the fundamentals for TLT don't necessarily point that much further downside. If we do get a bit of downside, I don't expect it to be a lot. And if anything, I wouldn't be surprised to see a break of 108 in the coming weeks or coming months. Moving on to the US dollar, we have more bearish price action in the last couple of days. So the US dollar was actually performing quite well after bouncing from a major area of support at between 102 and 100. That was a major area that we've spoken about for the last few months, and eventually reached a previous area of support turned resistance at 105.50. The first touch, it looked like it was consolidation before a potential breakout, and we were getting that breakout, but immediately reversed lower due to the banking turmoil, and we have now seen price decline to around 102.50 or so. Initially, a few days ago, there was a little bit of a reprieve from that, but bearish price action has resumed so far over the last couple of days, or at least the start of this week, at least. So right now, dollar, I would say, still under pressure. With rate cuts coming, that increases, or technically increases the supply of dollars. So it does tend to lose value. Okay, taking a look here at gold, looking at the GLD ETF. Now, gold is a very strong bullish candidate, in my opinion. But two reasons for this. One, it moves inversely with the US dollar. and the US dollar is under pressure, so naturally gold should move higher. And the second reason is due to the fact that gold is a safe haven asset. So we are still, the macro environment is still there's a high level of uncertainty in the macro environment, and we are seeing investors flock to gold. I mean, from 167, we saw how quickly price now rallied to 185, breaking to a new higher high. And yes, price is now pulling back. Big question is how much of a pullback will we get? Overall, I think that gold has a potential to reach the 192 area, which is a major area of resistance. And it's always good to look at these pullbacks as potential buying opportunities. We saw something quite similar to this in November, where we saw initially a very strong rally, but then the pullback was limited. I know right now, looking at it in hindsight, it would have made sense to get long anyway, in November. But at the time, I still remember my thought process was I was looking for a steeper pullback and for that bullish entry point, and that didn't quite happen. Price still managed to stay above its 21-day exponential moving average, and the pullbacks were limited, making it a very difficult entry point for a move higher. When you look at the risk to reward of the technical setup. And it's using that experience, I would say something similar might happen here, where we might get some pullbacks like we did during this rally for gold just a few months ago, but those pullbacks might be limited. So you may need to be a bit more aggressive if you are looking for a bullish opportunity here for gold, and look for the continuation higher with 192, 193 as a potential price target. Okay, and taking a look here at oil, looking at light crude oil futures. So interesting price action where we had a long period of consolidation between 81 and 70. As you can see on the daily time frame, price was stuck in that range, and it did provide some nice opportunities, especially for energy stocks when you're looking at shorter duration trades, where you could short at resistance, go long at support. And yeah, the trade duration was probably 1 week, 2 weeks max. Whereas now what we saw was a breakdown after the banking turmoil, and we are seeing a little bit of a reversal higher. It looked like price was rejecting a previous support level, turning resistance at 70. That did become invalidated yesterday. And we are seeing price back to the 72 level, but I would still consider 72 to be resistance. I mean, you can see it's actually acting as the more recent area of support compared to 70. So this area between 70 and 72, previous support, potentially turning resistance. Let's see, the next couple of days will be very important to assess whether oil is back within this range, or whether we get another shorting opportunity here for oil. And the next major area of support is all the way here at around 61, 62 or so. Okay, taking a look at sector rotation, not too much of a difference from last week, but we now have 3 sectors in the improving and leading category, and we have 8 sectors in the lagging and weakening category. So in the leading category, we have communications and technology. Communications losing out on a little bit of momentum, but nothing too drastic, whereas technology, once again, providing very, very strong leadership. Now, remember, technology has a huge weighting in both the S&P and especially the NASDAQ 100. And what we saw during the pandemic recovery period was narrow leadership among the sectors, meaning all the other sectors were underperforming, whereas technology was outperforming, and outperforming by quite some distance, which allowed the rest of the major indices like the S&P and the NASDAQ to rally as well. So don't underestimate the power of the technology sector, but it is quite interesting to see how sensitive technology is to potential rate cuts from the Fed. So yeah, that is why we are seeing a lot of rotation into technology. Otherwise, we would be seeing a lot more rotation into our defensive sectors like utilities, healthcare, and staples. We are seeing some rotation. As you can see, there's been a pickup in momentum over the last 2 weeks. And this has to do with the uncertain macro environment, but most investors seem to be rotating back into technology. Energy performing quite poorly due to the oil breakdown, as well as real estate. A few weeks ago, looking like it was primed to rotate into the leading category, but losing out on a lot of momentum and relative strength to be back in the lagging category. Okay, taking a look here at IBB, which is the biotechnology ETF, taking a look at some subsectors of interest. So IBB, we did cover this for quite some time, provided a very nice shorting opportunity ever since, prices at 138. So I know I've been looking at this name for a couple of months now, but it was an excellent bearish trade that worked quite well. And there were a few legs to it, right? There were 3 legs to this trade. And price is now at a major area of support at 122. It bounced on that level. And what we are seeing is some consolidation, not a lot of bullish momentum, but bullish momentum is improving slightly. Taking a look at the weekly time frame, though, what we have here is a bit of an ascending trend line, maybe not a perfect ascending trend line, but we are noticing a pattern of higher lows. And the fact that price is bouncing from a major area of support would indicate that the risk to reward here does favor the upside. Remember, biotechnology part of the healthcare sector, and healthcare has been underperforming, but doesn't mean it's going to be underperforming for that much longer, especially in an uncertain macro environment. So for that reason, I am looking at actually going short-term bullish here for biotechnology. What I would like to see is a break above 128, because right now, this 127, 128 area is where the consolidation is happening. And I want to see a bit of a breakout, and I want to see some momentum there for a revisit back to maybe not 133. I'd probably target 138 as my upside target. 133 was definitely a major resistance level a year ago, but more recently, price has somewhat dismissed that area and formed new resistance at 138. Taking a look at the semiconductor ETF, SMH. So SMH, nice bullish opportunity here, in my opinion. What we saw for the last couple of years, or let's say for the last year, was a very strong decline, a lot of rotation out of this subsector. Price did bottom out at 165, a major area of support, managed to recover, forming a bit of a capitulation here with a inverted head and shoulders. And I would say price is now breaking above a major level. Well, it did break above a major level, and it's breaking above another one now at around the 245 area. We are seeing momentum improve on the weekly time frame and very bullish price action. That being said, ever since price reached the 260 area, it has encountered some resistance, and we are seeing a bit of a pullback, but this pullback would provide an ideal risk to reward long opportunity. Remember, technology stocks are doing quite well. Semiconductors is part of the technology sector, and therefore I am looking at these long opportunities and adding them to my bullish watch list. Because there are a lot of good names in the semiconductor sector. In terms of upside targets, we have 280 as a potential area of resistance, and from there, obviously, would be 320. Okay, moving on to some market observations. The first one I have is actually a bullish trade on Zscaler. So Zscaler, over the last year and a half, really suffered some pretty drastic declines. Price declined from 380 all the way down below 165 to complete the topping formation. But on the weekly time frame, as you can see, it is finding it's finding some bullish price action at a major area of support at around the 100 level. Price forming a bit of a double bottom there, finding some momentum last week. And let's shift the focus to the daily time frame. What we've seen here after that initial push, a bit of consolidation before potentially another move higher. The risk to reward does favor the upside, but I'll be looking for a break and a close above 115 as a potential trigger for this trade. And I'll be targeting that 140 as an initial take profit zone, and even 165 as a secondary take profit zone. As you can see on the weekly time frame, that did provide some resistance and support in the past. Okay, moving on to AMD, so another semiconductor play. And I explained my reasons as to why I like semiconductors, and AMD is definitely one of the best in class for semiconductors. So not a very actionable trade.